the people who are playing the paper game in gold are the same people playing paper games in other derivatives, the same players, the same hedge funds, the same banks. So on that basis, systemic risk in the gold market is actually a very, very serious issue.
And I'm reasonably certain, although I don't know why, that history will repeat in the sense that at some point in time, the generalist investor, who, by the way, does not yet know how to spell gold, will come down into our space. And when they do, I would suspect that the price appreciation that you will see in silver.
Alasdair Macleod is a sound money economist and head of research at Goldmoney. Macleod warns that a delivery crisis in the gold market is likely, urging investors to avoid counterparty exposure in paper gold. He explains that failure in the bullion paper market could trigger broader disruptions across the derivatives sector, as the same financial institutions involved in gold trading also hold significant positions in other derivative instruments. In May, delivery volume reached a record for what is typically considered a minor month. With 25,291 contracts settled, it even surpassed the previous high set in February. Despite these heavy deliveries, total Comex inventories have declined since early April. Initially, metal surged into vaults to meet demand, but that trend has reversed as delivery volumes fall and gold is once again being withdrawn. June also witnessed a notable rise in net new contracts. Futures opened and settled for immediate delivery. However, even central banks face these dilemmas. Macleod explains that central banks storing gold at the Bank of England have leased it out to reduce storage costs, while the bank claims the gold remains safely under its control. This arrangement illustrates the very counterparty risks that Macleod warns individual investors to avoid, as actual ownership and control of the gold become ambiguous even at institutional levels. Central banks increased their allocations to global gold reserves in May, with the National Bank of Kazakhstan leading the pack. According to Marissa Salim, senior research lead, APAC at the World Gold Council, the People's Bank of China and the Czech National Bank both added 2 tons of gold to their reserves in May, while the National Bank of the Kyrgyz Republic, the National Bank of Cambodia, the Central Bank of the Philippines and the Bank of Ghana each added 1 ton of gold. Before we dive in, don't forget to like and share the video. Hit that subscribe button and turn on the notification bell so you never miss an update. Thanks to your amazing support, our community continues to grow.
You don't need an awful lot of that sort of demand to clean out the market. There is no real physical. I mean, okay, you and I can go in and buy a few coins or small bars or whatever, but you really want to take, you want to take delivery of a couple of tons. Ooh, join the queue. This is not something that's going to happen easily. So the point is, let's just go back to the problem. The problem is that a central bank, which had its gold stored at the Bank of England, has so far been quite happy to lease it out to help pay the costs of storing it at the Bank of England. And the Bank of England has been very happy to act as agent for it and saying, well, you don't worry. It sort of, it'll remain in our vault. So we've still got control over it. Yeah, like hell, it's gone. So what does the central bank think? And I'm talking about, like the Central Bank of Finland, for example, who did disclose that they had something, I think it was something like 60 tons in the Bank of England. This was quite some time ago. And they made a big error by telling me that they were leasing half of it. And then they went quiet on the whole thing. I had a Finnish friend who gave me the translation, so on. So, so, okay, you're the Bank of Finland. You're sitting there, you're thinking, God, our gold's gone. What are we going to do? It's a quick call the Bank of England. Where's it gone? Well, the answer basically is that you're not going to do any leasing ever again. And probably you're going to turn around and say to the Bank of England, hey, come on, we want to ship back to us, just like the Bundesbank did to the Bank of New York, about 10 years ago? The Federal Bank of New York. 10 years ago. Now, this is desperately important because the liquidity in the paper market depends on this leasing game and the rehypothecation of leased gold. And it's a circus which is run by the Bank of International Settlements and also the Bank of England and also the New York Fed. They have lost their liquidity and there's a hell of a lot of gold gone missing. So how do we sort this one out? I mean, the answer basically is that the paper market is ending along with the fiat currency system. And this ending of the paper market is not going to be a simple wind down at all. No, I think it's quite likely to create crises of delivery, which I wouldn't want to be. I wouldn't want to have counterparty risk in the paper markets at all. And if the bullion paper market has problems, then you can imagine that that's central to virtually the whole of the derivative industry. Not directly, but indirectly. Because, of course, the people who are playing the paper game in gold are the same people playing paper games in other derivatives. The same players, the same hedge funds, the same banks. So on that basis, systemic risk in the gold market is actually a very, very serious issue. I think it's bound to, because all these markets are basically priced on the back of derivatives. And, if you can't hedge, let's say your copper or whatever because of counterparty risk or whatever, then obviously it's going to have an impact on underlying prices. It must do. I would think it would lead to relatively immediate demand for virtually all commodities, because the point about derivatives is that you can have a derivative without actually having to own the stock. So you can always use derivatives to protect your price ahead of delivery or ahead of a commitment. But when you can't use the derivative anymore, then you've obviously got to go out and get the stuff in because you're going to have obligations, if you like, on the other side in terms of delivering product. Whether it's mild steel or copper or silver or lithium or whatever it might be. Yeah. And also oil too, energy. That actually could be a very, very big consideration.
Rick Rule is a veteran natural resource investor and founder of Rule Investment Media. Although generalist investors are not yet focused on the sector, Rule is confident they will eventually enter, driving silver sharply higher as seen in previous bull markets. This anticipated influx of investors aligns with current market projections. Silver bullion investment is projected to rise by 3% in 2025 as Western investors adapt to higher prices, easing profit-taking and boosting new demand, according to the Silver Institute. Meanwhile, Metals Focus forecasts a 2% increase in mine output. Many analysts agree that the most likely scenario lies somewhere in the middle, where balanced supply and demand dynamics maintain steady price growth of silver, along with inflation. This fundamental strength underpins Rule's longer-term conviction. Beyond these near-term projections, Rick Rule believes that silver will eventually surpass its previous all-time high from 1980, not just in nominal terms, but in real, inflation-adjusted dollars. Like other precious metals, it tends to retain its value better than investments such as stocks and bonds. Let's get back to the interview.
The momentum in the gold price first moves the best gold equities, which we've seen in the last 18 months, and then moves down to the mid-tier gold equities. The generalist investor becomes enticed with the precious metals narrative. When the generalist investor comes into our space, market leadership, and I'm not sure why, I suspect it's the lower unit price, market leadership switches from gold to silver. I've watched it happen 3 times before in my career. By the way, when that happens, you won't need Rick Rule to tell you that it's happening. It will be very, very, very obvious. As I say, I don't know why leadership switches to silver, but it does. I think we're in a precious metals bull market that is likely one for the record books. More dramatic than the 2000 to 2010 market, more dramatic than the 1998 to 2006 market, for the reasons that we talked about at the beginning of the show. And I'm reasonably certain, although I don't know why, that history will repeat. In the sense that at some point in time, the generalist investor, who, by the way, does not yet know how to spell gold, will come down into our space. And when they do, I would suspect that the price appreciation that you will see in silver will be as dramatic as it has in the past. Let's say that I believe that gold will take out its former, or silver will take out its former all-time highs in real, not nominal dollars, okay? That it will take out its all-time highs in $1980. In fact, let's say that I think it'll only go to half its all-time high in nominal dollars. That means that the silver price from here triples or quadruples. Now, while I would like to know when that's going to occur, I can't. If I got a quadruple or a triple in a year, would that be good? How about 2 years? Would 3 years be a sufficient amount of time to wait for a triple or a quadruple? The truth is that people who can't familiarize themselves with those probabilities are people who would be best off still believing in the tooth fairy. I also have a disgustingly large percentage of my portfolio in gold mining stocks. But that's my trade. That isn't just an investment. It amuses me. And speculation in natural resources is how I ended up with an economic surplus to save in anyway. If a rational financial planner looked at my portfolio, even assuming that financial planner was not unsympathetic to gold, he'd say, Rick, you're out of your mind. Your income will go crazy in the kind of gold market that you're forecasting. You don't need to own gold to protect yourself. But the truth is that I believe that the essence of money, the essence of wealth, is enhancing your sense of well-being. Reread Aristotle, and I paid some attention to gold markets in my lifetime. And I decided that one thing that I would do is keep an alternative set of books for myself and my family. The official set of books, the ones that I pay taxes on, are denominated in US dollars, of course. But I began to systematically save in gold, and I began every year to recharacterize my assets, my liabilities, my savings, and my expenditures in gold. And that's been an extraordinarily useful exercise for me. When people say to me on podcasts like this, or they don't say it now, but 2 years ago, they say, or 3 years ago, when's the gold price going to move? And I could look at them with a very straight face and say, well, the gold price is going to move in 2000. It has increased in price by 8.5% compounded for the last 20 years.
Gold and silver continue to present compelling long-term opportunities, with silver showing notable upside potential as it advances toward historical highs in real terms. Strengthening physical demand and ongoing supply constraints position both metals to benefit from shifting investor sentiment, deepening market imbalances, and rising concerns over systemic financial risks. Analysts remain upbeat on silver's outlook, highlighting its strong momentum as it carves an independent path from gold. Having started its upward trend in 2020, before any tariff impacts, silver now appears to be gaining additional support from trade policies, with its multi-year trajectory pointing toward a potential challenge of its all-time highs. Much like gold's ascent into record territory, can silver follow gold's lead and break past its all-time high in the coming year? Share your thoughts in the comments. Don't forget to like the video, share it with friends, and subscribe. Only 2.3% have subscribed so far, so hit that button and stay updated with the latest insights.